morning, everyone. So basically, world according to GiveCal research, we had the opportunity to meet Mr. Louis GiveCal last week, and this particular research firm has been there for last 20-25 years. And the market participants finds the research to be insightful, and therefore we have taken the liberty to take few slides from his presentation in our monthly presentation. Starting with, let's say, we all know that US equity markets have been doing well right from 2012 onwards. In the beginning, starting with US shale revolution, followed by tax cuts in US, then the stimulus which was given during the COVID time, and the recent AI related investments and the boom. US equities have been rallying one way right from 2012 till, let's say, 2025. US constitute only 25 to 30% of the world GDP, but US share in MSCI global market cap is close to 65%, 66%. Again, this is the chart where we have compared the dollar index during this term vis-a-vis Trump's first term. In 2016, before Trump came into power, or in 2016 when Trump came into power, between September to December 2016, dollar appreciated by close to 10%. And in the entire calendar year 2017, dollar depreciated by 10%. This year also, in calendar year 2024, we saw dollar index appreciating by close to 10%. And now, in first 2 months of 2025, we have seen dollar depreciating by close to 8 to 9%. In entire calendar year 2017, dollar depreciated and it broadly stayed in a range. Hopefully, this time also, after the recent correction, largely dollar index continues to stay in the band of 100 to 105, currently trading at around 103. Obviously, there will be outliers, but largely dollar, the worry which was that dollar index will continue to appreciate seems to have subsided. Again, US equity markets have done well for last 13 years, but is the US dominance under threat? Probably due to these reasons, it's quite possible. One, after the DeepSeek, whether the US companies will reduce their AI investments, or probably the shareholders will also question the investment made by US tech companies. Again, for some period of time, the Magnificent Seven seems to be facing problem either from competition from China, or let's say downward pricing pressure on the cloud front, or let's say antitrust issues which are domestic issues in the US, where people have been questioning the size of Google and, let's say, Meta. Finally, Europe has also started talking about spending, increasing their fiscal spending. So quite likely that investors may shift from US markets to Europe. Again, China seems to be doing better, and probably investors may shift from US to China. Or probably, let's say, let's say autonomous driving. Now, China seems to be leader in autonomous driving, robotics, and nuclear industry. Or probably, let's say, because of the fiscal stimulus worldwide, commodity demand increases, commodity prices increases. Therefore, probably the new leaders will be countries which are actually exporting commodities. So, US after rallying or after doing good for last 13 years, people have started questioning whether US equities are likely to continue to do good over, let's say, over the course of next 2 to 3 years. Again, Fed has done a fantastic job. When Fed raised rates by close to 500 basis point in 2022, everybody was fearing a hard landing in US. That means we'll see a recession in US. But Fed has achieved soft landing in US, where inflation has come down, whereas the US economy has not got into recession. US economy continues to grow at 2.5%, and inflation has also come down. Core PCE inflation, which Fed tracks, is currently in the band of 2.5 to 3%. And the amount of basically quantitative easing which US had done during COVID times, Fed has also rolled back some of the quantitative easing, and now they have rolled back close to 40% of the quantitative easing which they had done during the COVID time. Again, the dodge. Finally, the US Fed is likely to cut rates, and US Fed will be guided by the unemployment rate in US. Currently, unemployment rate in US is close to 4.1%. The new Dodge department, which has been made under the US Trump administration, they want Fed to lower rates more. They are focused on cutting costs, and therefore the number of jobs addition which is happening in US government department in February 2025 is much lower than what jobs were added in February 2024. So whether these fewer jobs addition or people being removed or being offered a severance package, whether it will lead to increase in employment rate in US and finally more easing by US Fed over a period of time that we usually see. Again, the Trump tariff policy is creating havoc on global growth. What we have seen is that they implement tariff, we have seen market prices going down, they're scaling back on their tariffs, and we have seen market going up. But this uncertainty, yes, markets also don't like so much uncertainty, and similarly, businessmen also don't like uncertainty. Everybody is pushing back their investments, which will in turn impact global growth. Again, based on the news, if US truly implements the tariff which is doing circles in news, the effective tariff rate which US will impose on other countries will be close to highest what they have levied in Great Depression, closer to 18%. Again, for multiple months presentation, we have covered this that the fiscal deficit in US is elevated. During COVID time, the fiscal deficit was close to 15% of GDP. Yes, it has come down, but it still continues to remain elevated. However, Trump administration is aware of this and they want to take measures to reduce the fiscal deficit in US. The US national debt has surpassed $36 trillion. Again, in our previous presentations, we have covered that incrementally in US, if you increase the fiscal deficit by $1, it is adding only close to 60 basis points to your GDP. And therefore, probably, and the current Trump administration and the Dodge is working towards bringing down this fiscal deficit over a period of time. But in order to reduce fiscal deficit, yeah. Finally, in order, basically, because US has a high fiscal deficit, and if interest rates continue to remain elevated, they are going to find it difficult to fund the fiscal deficit, and therefore, the Dodge administration or Trump administration is focused on bringing down interest rates in US. Finally, based on our reading, we believe that the Dodge and Trump administration want three things: lower US rates, lower dollar index, and lower commodity prices. The global PMI still continues, though it has improved in February 2025. The global PMI still continues to remain weak, though it has shown some improvement in February 2025. The global PMI is weak. Again, global commodity prices are relatively benign. We have seen recent correction in crude oil prices, and because of, let's say, uncertainty on the tariff front, demand scenario also seems to remain weak. Global demand scenario and global commodity prices are also relatively soft. This Trump administration will not mind because lower commodity prices will lead to lower inflation in US, will open up space for Fed to cut rates more. What are the emerging trends what we are seeing in 2025? One is the release of DeepSeek by China has shattered the belief that China does only manufacturing while US does digital. Over a period of time, this will also question the investment done by US tech companies into AI. So slowly or gradually, the US dominance in the digital space seems to be reducing, and this trend is likely to persist during the entire calendar year 2025. It also seems to be clear that the Dodge seems to be very, very focused and seems to be serious about cutting costs. They want to reduce the fiscal deficit and they also want lower interest rates in US. China, if it is successful in transitioning from, let's say, real estate economy to, let's say, an industry-led growth, it will lead to further investment in industry and may further help Chinese growth. And therefore, China seems to be in a proper bull market, seems to be the emerging trend. Similarly, let's say certain US allies like Canada and Eurozone, they are also post the noise around tariff. They also want to reduce their reliance on US, and Canada is talking about infrastructure spending. And similarly, Eurozone, we have seen that they have recently increased their fiscal spending in order to support their economy. Again, this point that over the course of last 2 months, the US 10-year cost of borrowing has come down. So a US 10-year bond which was trading close to 460, 470, it has come down closer to 420. Broad reason for drop in US long-term yields is one is people are believing that US growth will be weaker this year. So the initial expectation, which was around 2.5% US growth, now people are expecting close to 1.5% growth in US. And second, Dodge actions where they are focused on reducing the fiscal cost. They are asking people or probably adding fewer jobs will lead to increase in unemployment rate in US. So higher unemployment along with let's say higher unemployment rate along with lower inflation will lead to US Fed cutting more rates, and therefore US Treasuries have come down from close to 50 basis point over the course of last 2 months. And what we have seen is dollar index has also corrected along with the drop in the US yield. So broadly, based on let's say trends which we had seen in 16, 17, largely we believe that probably the US dollar still seems to be over, and largely US dollar should now trade in a range of let's say 103 to 106 over the rest of the year. Again, since the release of DeepSeek, what we have seen Chinese equity, Chinese tech stocks have delivered better returns this year. Chinese tech stocks are up by close to 25-30%, whereas US stocks are more or less flat. Again, we all keep on reading in news that China real estate market is in problem. Banks are lending less money to Chinese real estate companies. But since 2020, we have seen a pivot where Chinese banks have lent more to the industrial sector, and they have reduced their lending to the commercial sector, commercial real estate sector. And therefore, this trend is emerging. If China is successful in reviving an industry-led growth, then probably more investment will come in industry and it will propel Chinese growth further. Again, probably China continues to be the major or the highest exporter of automobiles across the globe. China in last 1 year has exported more than 5 million vehicles across the globe. Again, Chinese companies is helped by lower cost of borrowing. So the Chinese government is borrowing 10-year money at a cost of closer to 2%, whereas US the 10-year cost of borrowing for US government is close to 4.5%. So finally, lower cost of borrowing for Chinese government is also helping lower cost of borrowing for manufacturing companies in China. Again, probably a US-China summit is likely probably in the month of May or June. Starting April, US is going to levy tariff on China. Probably it may, we don't know the exact percentage. That will be based on the recommendation of the committee which has been set up by Donald Trump. But probably he will keep those higher level of tariff at least for a month. He will see the reaction from China and then he'll go and negotiate with China. What is US going to ask from China? That Chinese government or the Chinese central bank invest more money in US treasuries. Probably they'll ask for the sale of Panama Canal. They'll ask Chinese companies to set up factories in US, and they may ask Chinese government to allow their currency to appreciate. Finally, it looks like Xi Jinping does not seem to be overly worried with respect to tariff. They have given relatively less domestic stimulus last year. So the Chinese government can announce an additional stimulus to support the domestic economy. What China is worried is basically US does not spread an anti-China basically coalition, including let's say because US has many allies like let's say Europe, Mexico, Saudi. Along with it, it does not let's say follow anti-China propaganda. And push come to shove, basically the Chinese government can actually ask certain Chinese companies to set up factories in USA in order to reduce the tariff. So let's say if some deal happens, let's say in the month of May or June, then which is positive where USA also reduces tariff and China also giving something, it may result in dollar weakening and we'll see the markets across the world rallying. Again, there are not all positives. There are some negatives with respect to China. We always talk about US debt. but Chinese debt as a percentage of GDP is the highest among US, Eurozone. So Chinese debt as a percentage of GDP is close to 300%. Second, the Chinese domestic economy doesn't seem to be doing that great because consumption as a percentage of the GDP, wherein India is close to 60%, consumption drives close to 60% of our GDP. In China, consumption seems to be driving closer to 40-45% of their GDP. And however, let's say if the Chinese government, if let's say if tariffs are deployed on China, if Chinese equities fall, in order to support market, the Chinese government can actually take some measures, announce the fiscal stimuli, which can propel Chinese market high. Again, the fund manager seems to be very are not worried with respect to the global scenario. The confidence level is very high. This is a Bank of America fund manager survey, and the average cash levels which are held by, let's say, fund managers across the world is relatively lower, closer to 3.5%. That means they see prospect of equity markets delivering better return across the globe high. Now, obviously, global investors over a period of time will come to know whether they'll continue even after US equities rallying from, let's say, 2012 to 2025, they'll continue to stick with US markets, or they'll prefer to buy a cheap market like China. Again, in terms of policy in China, we are seeing easy fiscal and monetary policy both. Plus, let's say government can support their equities, government can buy equities in China. In USA, we are seeing that the Dodge is focused on bringing down the fiscal deficit, whereas probably Fed is likely to ease by additional 50 to 75 basis points during this year. The momentum seems to be strong in both Chinese market for the time being, in both Chinese market as well as US market. In terms of valuation, Chinese equity valuation seems to be in the bottom quartile, and US equity valuation seems to be in the top decile. Chinese equity market is massively underowned, whereas US equity market seems to be massively overowned. In terms of bond yields also, bond yields are higher in US and bond yields are lowest in China. Again, we are talking about China and US, but can Eurozone be the winner this year? Because Euro governments have also started spending heavily on fiscal, which will lead to increase in demand and probably their GDP may turn out to be higher than what is initially expected. So again, by focusing on China and US, global investors may also be looking at Eurozone markets. Again, this is a chart which shows that every 10 years, the sector as well as the countries keeps on shifting every 10 years. So let's say in 1980, the theme was oil, and largely it was US dominated companies. Between in 1990, from 80 to 90, Japanese equities were doing good. In 2000, basically between 90 to 2000, US tech companies were doing good. Between 2000 to 2010, basically the China story played out. And from 2012 till 2025, the US markets are doing good and US tech stocks are doing better. So whether every 10 to 12 years we have seen shift from, let's say, US to emerging markets, back to US, back to emerging markets, back to US. Whether this trend, again, based on this trend, ideally, next 10 years should ideally be to other emerging markets. However, we need to see whether or probably this time US tech companies or US tech stocks or US markets continue to deliver better returns for next 5 to 7 years. That needs to be seen. Coming back to Indian economy, these are the headlines. Indian GDP grew at 6.2% after growing at 5.4% in second quarter. Again, let's say RBI after 5 years, RBI has cut rates by 25 basis point. GST collection rose by 9.1% in February 2025, and India PMI has dropped a little bit in February 2025. Again, we keep on mentioning that India is one of the fastest growing economy in the world. But if you look at the 10-year data, India has been the fastest growing economy in the world for last 10 years. Our GDP has grown by 77%, followed by China, whose GDP has grown by 74%. And US GDP has grown by only 28% over the course of last 10 years. India growth has recovered. So in second quarter, our growth rate was 5.6%. Yes, our growth rate has improved to 6.2%. And the fourth quarter GDP is also likely to be somewhere closer to 7%. But let's say our potential growth rate is anywhere between 7.5 to 8%. So we have a long way to go. Again, for this year, for FY25, again, based on the market estimates keep on changing. In first half or in September 24, the market expectation that was that India will grow at 7%. However, that expectation has not come down to somewhere closer to 6.5%. So we believe that India in FY25 will grow closer to 6.6 half. And even in FY26 next year, we believe India growth is likely to be closer to 6.5%. Based on the various economic indicators which we are tracking, we believe that the pickup in growth which we have seen seems to be sustaining. And if the growth continues to remain sustained, then we will also see increase in capacity utilization over a period of time. Again, we all know that a better monsoon bodes well for the Indian economy. Last year, the monsoon was 8% surplus. This year, the estimates are not yet out, but a favorable monsoon, along with these high water reserve levels, will also help agricultural output and rural income. Now, rural demand for last 3 quarters is higher than the urban demand, as reflected from the FMCG volume growth. So, rural economy seems to be doing better than the urban economy. And the financials of Indian companies seems to be better. Free cash flow generation as a percentage of sales is closer to 7%. Yes, it has seen a drop from close to, let's say, 9%, but it is somewhere closer to 7%, a healthy number. And similarly, the leverage of the companies is low with debt to EBITDA close to 1.5 times. This shows that, let's say, if companies sees demand, they have the ability to put in capex if required. Again, Mr. Modi and Trump met, and the key highlights of the summit is one, they have agreed to increase the total trade from $190 billion to $500 billion over the course of next 5 years. India will increase its import of oil and LNG from US from current $15 billion to $25 billion. They have agreed for a US India defense cooperation framework. US is likely to make more investment into India's infrastructure, manufacturing, and renewable sector. Similarly, US wants to position itself as a primary partner in India's high-tech and semiconductor manufacturing. And US wants India to work along with US to reduce China's influence in trade and security. Oil prices, basically, again, Trump administration is working in de-escalating the tension in Ukraine and Russia, along with concern on the global demand, has resulted in oil prices correcting. And oil prices, Brent prices are currently trading in the band of $70 to $75 per barrel. Given the pressure on the currency front, given the FI outflows, a lower commodity prices will help us in having lower current account deficit, and it will reduce the pressure on the currency front. Again, GST collection for the month of February has been lower at 9.1%. Our nominal GDP growth rate for this year is pegged at 9.7%. So GST growth rate for the month of February is lower than the nominal GDP growth rate. However, from April till February, the growth rate is close to 12%, which is way higher than the nominal GDP growth rate. Again, we are focusing on FI outflow, but there seems to be worry on the FDI front also. In FY24, the total FDI inflow was close to $10 billion. In FY25, the FDI outflow has picked up. And this year, the FDI inflow is likely to be closer to $1 or $2 billion as compared to, let's say, $25 to $30 billion, which we have seen in the past. Our central government is focusing on fiscal consolidation. Government, when it presented its budget in February 2025, reduced the fiscal deficit from 4.8% to 4.4%. However, states and our central government fiscal deficit seems to be non-inflationary. They are increasing their capex spending, capital expenditure spending, and reducing their revenue expenditure spending. However, states' budget shows a different picture. States seem to be doing capital, basically money transfer, and the total stimulus in terms of cash transfers, which is likely to be done by all states, is in excess of close to 2 lakh crore. So here, our reserves in the third quarter has fallen from $705 billion to close to $640 billion. Ideally, based on the trade deficit, our trade deficit was close to $81 billion. We had services inflow of close to $50 billion. So our reserves should have ideally fallen by only $31 billion, but they have fallen by close to $65 billion because RBI has been intervening in the foreign exchange market to prevent sharp depreciation in the currency. And in the process, when RBI is intervening in the foreign exchange market to prevent currency depreciation, in the process, it is also withdrawing some liquidity from the banking system. And therefore, you would have seen RBI taking measures to infuse liquidity back into the system to support the economy. Again, this chart shows whether a particular economy is in stagflation, reflation, stagnation, or Goldilocks. India seems to be in Goldilocks given that our nominal growth rate is closer to 10.5%, and inflation projection for FY26 is closer to 4.5%. So based on this chart, it appears that India is in Goldilocks, and that is a favorable, any economy would prefer a Goldilocks environment, which is favorable for both equity as well as fixed income market. With this, I'll hand over to Rohit, who will cover the equity market.
You and good evening. Just talking about where we are in terms of valuations. Thankfully, we have come down a bit in terms of market capitalization. But we are a little bit higher than the overall average. Quickly moving to the next part, where we are talking about the profit growth versus the market cap growth. In the last 5 years, and even before that, our CAGR in terms of profit growth has been a good, respectable 26%. And in the recent terms, the 22 to 26 period, our CAGR growth of profits is higher than the market cap. As far as valuations are concerned, for large caps, they have come in line with the historical valuation. Mid caps and small caps are a little bit premium. Finally, moving to earnings. Now, in earnings, there are two parts. One is the very near term. In the near term, what we have seen in the last quarter, large cap earnings have been largely in line. Mid cap earnings have been above estimates. There have been surprises, and small caps have shown earnings below estimate. How does that impact the full year estimates? Now, one hears a lot about earnings estimates for the year lagging. If we do a simple, what is left to be, done in terms of company numbers, Q4 is like 276 rupees, and Q4 is always heavy. So in terms of that, there doesn't seem too much of a risk of earnings. So despite these being consensus earnings and all, there doesn't seem to be too much of a risk. The risk is like marginal 2% types. And if we are looking at the growth for the next year, while we are building 13.8%, or consensus is building 13.8%, there is not a chance of a massive sort of downgrade in earnings. Should be around about this number. So 1-2% plus minus, that's the number that we should look at. This is something which we are all aware of, that FIs have sold a lot and we are facing the pressure. But let's look at from the perspective of historical numbers, and I would request you to look at the fifth column. So if we look at it this way, then yes, we are higher. So these are the periods where selling has been on the higher side.
Hi, good evening to everyone. As Rohit was explaining, FPIs have been selling in Indian market, but ऐसा नहीं है कि उन्होंने बहुत ज़्यादा बेचा है. What they have sold is about 25%, $25 billion between October to February 25. And at this point of time, it looks like FPI selling may continue for some more time. Should we go and sell with FPIs? The answer is no. while we do believe FPIs will sell for some time, but I don't think so it is worth following them. Again, if we see FPI, they have been seller in large caps, they have been seller in mid caps, but in small caps, they have actually kept on increasing their stake. Within FPIs, long only, insurance, pension, and passive funds have sold, but sovereign wealth fund and university endowment fund have been buyer. Against FPI, domestic institutional investor flows have continued very strongly, and they still have firepower to buy more if prices continue to fall. Since we know FPI side, we are buying at a lower and lower prices and allowing market to come down. The relationship between developed market, emerging market is based on valuation. There are periods like 1989 to 94 when emerging markets did very well. Then 95 to 98, American market did very well. Then 99 to 2010, emerging market outperformed. And then 2011 to 24, US market did very well. Now, maybe this will continue for 3-6 months, or maybe this is the bottom. But there's no price for guessing. Eventually, will emerging market outperform American market or not? And if that happens, FPIs will be buyers in India. India's contribution to global GDP is about 3.4%, and our share in market cap is about 3%. This is one of the rare period where our share in global market cap has come down below our GDP. And more importantly, we have the highest return on equity in local currency terms in the world. Our valuation premium, we were always trading above valuation, above premium to emerging market. Now, against historical average of about 72%, our average has come further down to 48%. FPIs are now owning about 16% of Indian equity. Our weightage in benchmark index is about 19%. When they were owning 20% and our weightage was 17-18%, it was easy to sell. But now weightage is 19% and ownership is 16%. We don't think they have unlimited amount to sell. More importantly, the kind of growth which Indian markets have offered is truly amazing. In last 10 years, Chinese EPS has grown at about 36% in renminbi terms. US EPS for S&P 500 has grown 124% in dollar terms. And Nifty 50 EPS has grown 180% in rupee terms. Last 10 saal were very good for China. Maybe next 10 years will be very good for India. In that case, this can widen. Our earnings growth and return on equity could be superior to China and even US, and that may result into more money coming to India. In some sense, there was excess return made between December 19 to December 24. Large caps went up 4 times. The micro caps went up almost 7 times. And undoubtedly, some of those gains are getting corrected. Many stocks have delivered supernormal return. Even at this market level, 242, 1 out of every 2 stock in BSE 500 have delivered return, which is more than double in last 5 years. 149 stocks are today trading at a valuation which is more than 50. What we believe is that going forward, returns will moderate significantly. Last 5 years return for broad market is 14%, driven by small and mid cap at around 20% plus or minus. 15 years before, the broad market return was 11%, driven by large and mid cap at 11%. 20-year return, if you see, is about 12%. And the difference between large, mid and small is almost negligible. Going forward, please don't invest keeping this return expectation. That's unlikely to happen. We believe this is probably more likelihood of return. So your investors will have to moderate return expectations significantly. Overall, be ready for volatility as FPI continues to be on selling side. US policies, especially of President Trump, continues to move American as well as global market. But rest of the thing seems to be coming in our favor with government stability, oil prices remaining lower, consumption recovering with 1 lakh crore plus tax rebate in the budget, Europe as well as Middle East slowing down in terms of geopolitical risk, and corporate earnings coming little below expectation, but still on the positive side. Our view continues to remain be overweight large cap and underweight small cap with neutral allocation to equity. Price is what you pay and value is what you get. When you buy at lower P, your returns are higher. And when you buy at higher P, your returns are lower. Somewhere we are at this cusp, and hence return expectations will have to be moderated. This is the chart of calendar year return of Nifty along with intra-year drawdown. Undoubtedly, year after year, Nifty has given intra-year drawdown. That means the difference between high and low. But over a period of time, it has delivered positive return. These are sectoral valuation. Automobile, thanks to the threat of electric vehicle, is now trading below historical average P. Oil and gas, thanks to lower oil prices, is trading below historical average P. Consumer, thanks to lower volume growth and suppressed profitability, is again trading below historical P. Private banks for last 5 years have underperformed market. Undoubtedly, they are way below historical average. Capital goods also have now started trading at marginal premium to historical average. Healthcare is around historical average. Technology is at a marginal premium, but that's mainly driven by mid-cap IT companies. And metal stocks continue to remain at some premium as people expect Chinese growth to pick up. Coming to equity market opportunity, a lot of people say fund managers don't add value, but this is the rolling return of our equity funds over 3, 5, 7, 10 years. Across all time period, we have added value. If you look at hybrid and other equity funds, across time period, there is better return than benchmark index. Someone will say rolling return is not the right category, right way. Point to point return, one should look on a point to point return basis also, bearing few exception. Across different time periods, we have added value. We have delivered better return than the benchmark index. This is other equity and hybrid funds, same story. If you look at SIP return, again on a 3, 5, 7, 10 year across most funds and most time periods, we have delivered better return than benchmark index. Next time when you hear media article or you read press report which says that fund managers are not adding value, do remember this slides which we publish on a monthly basis, and it clearly shows that across most time periods, most fund managers are able to add value. Some of these schemes which is worth pushing at this point of time is a large and mid-cap fund like Kotak Equity Opportunity, a contra fund like Kotak India Contra, or a multi-cap fund which invests across large, mid and small. Quant fund gives a different exposure to portfolio, to very selective pickup of momentum. Sectorally and thematically, consumption is the theme thanks to the tax rebate given in the budget. And banking and financial services the theme based on the valuation. If you look at how our calls have worked over the years, On broad equity, at the depth of the COVID, we became overweight. And somewhere around August 20, we became neutral weight. Markets have undoubtedly gone way ahead post that. But please remember, we were still neutral weight. Now, one can always say you should have remained overweight all throughout and become underweight here. But that's how financial planning doesn't work. You give call based on valuation, not based on momentum. Similarly, in large cap, July 21, ahead of the correction in October 21, we were overweight. And then again in February 24, we became overweight. In mid cap, somewhere around February 24, we became underweight. And today, market is almost reaching the same level. The same thing was in the small cap index. So by and large, this chart shows that if you take call based on discipline, it works over a period of time. We also run a fairly large passive portfolio. They are across market cap like large, mid, and small, or smart beta across momentum, low volatility, alpha, value, equal weight, or commodity funds like gold and silver. There are also sector thematic as well as overseas funds available. Coming to debt market outlook, US inflation has come down from highs, but it is still not reaching the Fed's target level of 2%. The Fed rate expectation is that there will be rate cuts, albeit the timing is getting deferred. RBI in India has come on a front foot providing liquidity, open market operation, variable reverse repo auctions, US dollar buy sell swap. Everything is adding substantial amount of liquidity in the system. Despite RBI playing so aggressively, continuous FX outflow and currency leakages ensured that systematic liquidity does not go beyond the required time. Overall, RBI's intervention has ensured that liquidity remains positive and 10-year yield has remained around 675 band. We believe going forward, inflation will start coming down as Rabi crop will be bumper, and next year's monsoon is likely to be average or normal depending upon the El Nino and La Nina indicators at this point of time. Consumer price inflation has fallen to 5-month low in January. It may start inching up little, but it will remain within RBI's target range. We believe even at 670 10-year yield, it is time to invest in longer term duration. And if you don't want to go for long term duration, then you can leave that job to the fund manager in dynamic bond allocation. On the debt side, we have fund called Income Plus Arbitrage Fund of Fund. It puts 60% money in debt schemes and 40% money in arbitrage scheme. Collectively, this fund has payoff profile comparable to debt fund, but it will get taxed at 12.5% post 24 months. Hybrid funds are also appropriate for debt investors, especially with this market correction, whether it's Kotak Debt Hybrid Scheme, the erstwhile MIP, or Kotak Dynamic Fund, where Deepak manages duration, or Kotak Balance Advantage Fund, or Kotak Equity Savings Schemes, where equity allocation changes based on valuation. They all have lower volatility and better return, thus suitable for a conservative investors. In terms of gold, since COVID days, we have been bullish gold. Bearing 2021, where that call went wrong, it has worked exceptionally well. Obviously, gold prices have shot up in recent times, and there is a short squeeze which is pushing gold prices higher. In the short to medium term, could there be correction in gold prices? Answer is yes. But over a longer period of time, we still believe gold prices will remain higher as central banks around the world, led by China and India, have been big buyers of gold. China has also allowed their insurance company to invest into gold. They have about $4.3 trillion of AUM. and they are allowed to put 1% in gold, that will be $43 billion buying of gold going forward. Uh, there are also some rumors of Trump levying import duty on gold in US. Keeping that rumor in mind, people have bought gold in America and delivery has moved from London to New York. If import duty is imposed, gold stored in US will go up and make quick money for the holders. But do remember, once import duty is raised, the same gold will be liquidated in the market, which could again bring gold prices down. We remain bullish gold over a longer period of time, notwithstanding the short-term movement, which may be downwards. Gold, in terms of other asset classes like oil versus average weekly earnings of US non-supervisory employees or US median house price, all suggest that gold has become fairly cheap relative to those asset classes.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.